Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is February 25th. It's about 8:10 in the morning. We are going to find out some big data right now in about 20 minutes, right after I tune out here. But here's what you need to focus on. The market's kind of mixed right now. Futures are a little down, nothing crazy. I mean, we're still seeing the volatility in the NASDAQ, but based on what we've seen last few days, it's okay, especially based on the fact that the S&P, the Dow, and the Russell are stable. Matter of fact, the Russell is actually higher. So the small caps are coming out of this on the right side. Now, the big reports that are coming out, and this is what I'm going to talk about, is jobless claims and GDP and durable goods. Now, durable goods is not going to be that huge, but jobless claims is. This is a weekly report, and we've been going back up to the 900,000 claims per week. What I find interesting about this report is the fact that it's not delayed. So this is based on last week's data, and we had 815,000 Americans apply for unemployment. And the number doesn't seem to be going down, and that's causing me a lot of heartache. And if the number is above the expectation, or if we're above 850, 860, it's not going to be good for the market. It's going to put some pressure on the overall market. As far as the GDP, this is the biggest report of the quarter, and this is telling us how the economy is moving, if the economy is moving forward or back, and we're now expecting a good number before we head back to south. Now, keep your eye on the number. If it's below 3.9, it may take a little bite out of the market. If it's in the 4 range, it should be okay. Now, the economy has been running hotter than usual the last several months because Americans have been getting aid and stimulus from the government. So that's impacting things. So keep your eye on these two reports and durable goods to a lesser degree. I don't think durable goods is going to be a big factor. The only thing we may show is there may be a little less demand than usual, but again, this is not the biggest factor. Durable good orders are expected to accelerate further in January. Previous was 0.2. We're expecting 1.1. But the range is all over the place, anywhere from negative 3.5 to positive 3. Anything above 1.1 will be better. Again, it's not as big of a factor as the GDP or the jobless claims. And the jobless claims has me really worried because the number has not been outperforming. It's telling us that people are still having problems finding work. And then we have the personal income and report on Friday, but that's a little more delayed. The jobless claim is not a delayed report. It's based on weekly data. Very important. Bond market still falling off the cliff. We are grossly oversold right now. There's a good chance we're going to come back up to the 50-day moving average, all the way from the 138 to the 150 level. Don't be surprised to see this. We are at 14 on the RSI. We are so oversold, it's stretched out like that. I mean, it's just very stretched out. In terms of global markets, as I mentioned, we are a little lighter, but again, the volatility has been so crazy on the NASDAQ, I wouldn't make too much out of it, especially in light of the fact that we are, in fact, let me just go a little closer here, we are in fact above the 50-day moving average. As long as we could stay above this level and not fall under here, we should be okay this time around and go back to the 340 level. I'm not expecting too much more upside because the momentum levels are stretched out to death. We're at an 11-year high on the number of stocks trading above the 200-day moving average, and this number cannot sustain itself. Now, global economy, there's a lot to talk about today. Federal Reserve Chairman said U.S. central banks are in no hurry to withdraw support. He's going to keep short-term rates steady, but long-term rates, as you could see here, they are bonds going down, interest rates going up. So that's going to create a little problem. Overnight, it's called inflation. Overnight, Wall Street hit a new high after Chairman Jerome Powell said Fed sees no sign of inflation, might rise out of control. And that's the truth. Look, the fact is, even if the curve gets widened, interest rates are so low right now. We're pretty far away from real inflation, but we are seeing construction basic material prices go up substantially at this time. This helped to dampen fear sparked by a rise in U.S. Treasury bond yield. Yes. An indication of inflation sentiment that rising price pressure might lead the Fed to raise rates. Very possible. But again, you heard what he says. He's in no hurry to raise rates. Global stock market prices have soared over the past 6 months, and they are stretched out, folks. Those sentiments have faltered due to warnings that rally might be too early and that inflation might rise, prompting central banks to pull back. I think we're going to see that, but not yet. I think we're going to see that after we have enough people vaccinated. Vaccinated. I think that the Fed is still really panicky that we're going to have a out of control COVID environment, and they want to be extra careful not to cause things to go out of whack again. The central banks earlier indicated that it would let the economy run hot to make sure recovery is well established following the deepest slump since the 30s. You would know it with the stock market being near all-time highs. Powell said it might take more than 3 years to hit the Fed target of 2% inflation. Wow. That's crazy. But that's reality, folks, and that's telling us that the stock market, or not really the stock market, the world economy is not in a place where a lot of people think it is based on where the stock market is right now. On Thursday, the yield on the 10-year U.S. Treasury note, or the difference between the market price and what a buyer would be paid when it matures, widened by 1.42%. Look at this thing. I mean, it keeps going down, which means it's a huge inflationary indicator. So here it is, the highest in just over a year, which means interest rates are highest in over a year and bond prices are lowest. Remember, they're inverse. The indication that indicated investors were moving money out of bonds, a sign they expect inflation to rise, which would reduce the total payout, because remember, if more of it goes into interest rates, there's less of a payout. Powell told the House Finance Committee the Fed was in no hurry to raise rates or trim its $120 billion in monthly bond purchases. That number is just crazy, which pushes down interest rates by making more money available to lending. Folks, would you be able to tell by this graph that they're buying bonds? I mean, look at this. You can't tell, right? I mean, it's hard to tell. Investors are also looking for Congress to approve President Joe Biden's proposed economic aid plan. That includes $1,400 check to most Americans. The plans face staunch opposition from Republicans and is still subject to negotiation, but I have a feeling we're going to get somewhere with that. Now, if you look at the NASDAQ 100, you will see that it's now above the 50-day moving average. I would give it one more day. But if you look at the SPY, you will see that it's actually doing quite well, and it's bouncing back really well. Now, if you look at the Russell, we're close to new highs. So the strongest index, I should say, remains the Russell, this Russell 2000, and that's where I've been telling you guys to put your money in, because the small cap stocks have a while to go. Now, I've got two small cap stocks that pull back. These are some amazing performers, as you will see in a minute, and it's a good opportunity for traders looking to get in on a good move. Now, I want to show you something eye-opening. This should be eye-opening. This is the S&P 500. Look at the S&P. This is 6-month price. Look at the biggest gainers over the last 6 months in the S&P. 168%, 139%, 143%, 108%, 144%, 197%. You're starting to see it's between 100 and 200%, right? Now, look at the 6-month highs on the Russell. 8,000%, 3,600%, 1,970%. 960%, 893%. So what would you rather have, between 100 and 200% over 6 months, or 3,000%, 1,970%, 852%? You think it's just because it's the S&P? How about the NASDAQ 100? It's a lot more volatile, right? Let's take a look. 149%, 142%, 96%, 93%, 93%, 89%, 89. 6 month, I'm ranking it by the highest. So this is the S&P. 197, 168, 160, 144. This is the NASDAQ. Let me go to the NASDAQ. And I'm organizing it by most to least, as you can see here. 149, 142%, 96%, 93%. Now let's look at the Russell. 8,000%, 3,600%, 1,900%, 960%, 893%, 800. Are you seeing what the Russell's giving you? So the Russell outperforms over a 6-month period on average the S&P and the NASDAQ by a factor of 6.5 times. I'm not talking about the index. I'm talking about individual stocks, which is why you should be focused on them right now. Now, I've got two for you. This is the Container Store. If you look at the Container Store, they sell containers. It's that simple. Specialty retail store organization products. People are buying homes. They need more stuff for reorganization. Indice, Russell 2000. Hello, hello. Consumer products. People are buying containers. Don't ask. They're buying containers. Just go with it. Look at the 1-year return, 284%. I mean, that's a pretty good return, a lot better than 150%. And here's what the stock looks like. And you could see that it's pulling back quite nicely. Actually didn't pull back all that much compared to the overall market, which is a good sign. The less they pull back, the more resilience they have. So you have a nice little buy opportunity here on a nice little pullback. That's TCS, Container Store, and I've been talking about this stock nonstop for the last year. Next one, Fiverr. It's a gig economy. Remember, people working from home, they get laid off, they're still doing projects, they charge $5. The stock is up 753% this year. Not 150%, not 200%, 753%. It's a marketplace where people buy gigs. In other words, you want someone to design a graphic for your website, pay them $5, they'll do it. It hit the 50-day moving average, which is really good, and it's bouncing off, and I like this stock as well. So Fiverr, ticker symbol FVRR, and the second one, TCS, the Container Store. And remember, right now, small caps is where the money is. Not just the money is, 6.5 times on average over the last 6 months. And this thing is going to go. And we're not talking about 5%. We're talking about 6,000%, 8,000%, 3,000% versus 150, 180%. You saw it for yourself. Now, small cap stocks have the potential, folks, to rally faster than their bigger blue chip cousins. I just demonstrated that for you. And yet many people ignored this sector in favor of companies they're more familiar with. It's very common for people on Wall Street to invest in companies they're familiar with. But that's really not the best approach. That's a huge mistake. Right now, small caps look to be on the verge of a massive breakout. In fact, they've already allowed me to signal impressive winners like 118% on PFSI, 153% on DDD, even 414% on CNE. The key to making these returns is learning how to spot small cap microbursts. Microbursts is where the money is, before they happen, not after the fact. And then riding that momentum as the stock climbs higher. It couldn't be easier. I'll even show you how I find these little known microbursts. I'll show you the whole thing. Just click on the link below and I'll show you how it's done. And remember, if you want some real gains, like 6.5 times as big as the S&P, 500%, 800%, 1,000% versus 180%, 6,000%, crazy numbers you saw for yourself, follow the link below. Click on the link below and I'll show you how it's done. And make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And don't forget, small caps is where the money is. Check out the little microburst strategy that I'm talking about. You guys are going to love it. And I'll talk to you guys soon. Have a great day. Focus on this data, GDP and jobless claims.